Why is the stock down when, for all intents and purposes, Total did beat expectations in terms of the other big oil companies?
Hey, Alex, I think the first point is there's sort of, you could call them a defending dividend champion from last year. But when you think about why they are, they've obviously got an elevated dividend, which means, therefore, they've had to make compromises elsewhere. First and foremost being their capex. They're at $12 billion for this year, and there are already questions asking whether that capex number has to go up in order to underwrite future cash flows, which in turn will fund their energy transition. And the second is total shareholder returns. Not surprisingly, having the biggest dividend means that any future buybacks could be quite limited unless we see oil prices staying where they are.
Do you think oil prices are going to stay where they are?
We think there's an overshoot for oil potentially significantly higher. We see a deficit in February of 1 million barrels rising to 2 million barrels by August. So we've been bullish oil since early last year, and there is a chance that it could overshoot only because as we see spare capacity in OPEC start to come down. In fact, I think OPEC adding barrels in April will be a very important signaling to the bears that don't believe the oil price should be where it is because you've had these Saudi cuts. Well, if Saudi were to raise production, that's because demand is holding up and better than we expected. That potentially is where we see the oil price start to move significantly higher as all eyes return to deficit and spare capacity.
It does seem, though, that no one really believes the rally, pointing to the lockdowns, for example, some softness in maybe the spot market, like spot prices, like for average selling prices up a little bit, down a little bit. What do you make of that?
Yeah, it's a great point, Alex, because it's a slightly surreal situation we're in. I mean, your oil prices rallying, equities aren't. We've got this decoupling, particularly in Europe, which you could argue is because of ESG, investors not wanting to buy. But while, at the margin, there are investors who won't buy oil equities because they're oil stocks, the majority of investors we speak to want to buy and get exposure to oil beta and believe that oil prices could be a way in. Having said that, with Europe still on lockdown, the fact that demand hasn't really recovered in the DM markets, and you have oil prices propped up by OPEC, there is this worry that it shouldn't really be at 60, and therefore why should I go and buy an equity when it could correct by $10 to $15? So the jury's out on demand, but more importantly, once we see a deficit emerge and Saudi not popping the market as much as it is today, that could be where the generalists start to step in. So in other words, if the back end of the curve starts to move higher, that could be the entry point.
Christyan, it's really interesting because while we're not seeing cash equities really reflecting the rally that we're seeing in the energy complex, we are seeing huge amounts of call buying for energy stocks. And this was being pointed out on the Markets Live blog a little bit earlier on my terminal. And I'm wondering whether there are those that are spending a lot of time focusing on the call market, on the options market at the moment, seeing something different here. Or is this part of the narrative we've been speaking about more broadly with beaten up stocks getting bid up by the Reddit crowd?
Yeah, it's a great point. I mean, the reality is that who are we speaking to? We're speaking to macro funds, quant funds, and there's a reason for that because they're doing the work and seeing the deficit that we see on the medium term. We're calling for a 5 million barrel deficit within 2 years, which, if not treated, takes oil prices over $100. So as much as we've seen a sort of correction to the downside of negative oil, we could see a correction to the upside. And that deficit is what's appearing on the radar of the options traders, the macro funds. But within the equities world, there's still a lot of skepticism as whether we're going to see that deficit, or will shale production respond like we've had before. And I think in some ways, when Biden got elected, we've seen a real surge in incoming from investors, particularly from the macro, who can see that this could be a game changer in as far as seeing a lack of future production coming from shale, which of course therefore means we get to see a deficit, which therefore then could see oil prices significantly higher.
So I'm trying to work out where you're actually going to have the equity have that true upside to oil prices. And this brings us back to Total and shale, like you mentioned. So if the E&Ps aren't going to up their spend, how much are they really going to benefit? And then if you have the Totals and BPs and Shells and Equinors of the world that are, changing their names, changing their business models, trying to get more into alternative energy than actual oil, like how do you play that?
For us, we're keeping it simple. Look, we want energy transition. We want it to be constructive and profitable. But if we see an upcycle, which are clearly it's clearly the base case of JPMorgan, we want to be exposed to companies who can give you that max cash return through a high oil price, and that's Shell and BP. So having cut their dividends and their capex, then cash break-evens are now around $35 to $40. At $60 a barrel, that's significant free cash flow, which first of all comes through deleveraging. So in some ways, you're buying these guys for fiscal gearing, and then through buybacks and potentially raising the dividends. So the equity story for us is get as much exposure to the high end of the cost curve, loads of oil beta with a positive transition, but first and foremost, let's keep the bread and butter. And interestingly, the investor incoming we've had is primarily around who do I buy on oil beta. It's not who do I buy for renewables exposure. And I think that's where the Shell and BP positively differentiates, particularly Shell, given they're the most exposed to energy recovery.